MGM Resorts International is currently trading live at $31.88, which is down 25 cents or about 0.78% in this midday session on November 7, 2025. Volume is tracking just a bit lighter than its daily average. Now, most people looking at that price see a casino company. They think of the bright lights of Las Vegas, maybe the recovery in Macau. They see a simple bet on travel and leisure, a reopening play that has now fully matured. But that is rapidly becoming the wrong way to look at this business. The expectation is that MGM is an old-world hospitality giant, a relic of consumer confidence. But the reality is that its future valuation is almost entirely dependent on something else, becoming a high-tech digital bookie. The tension between its massive, debt-laden physical footprint and its high-growth digital ambition is where the real story is, and it's a conflict the market is struggling to price correctly, as evidenced by the stock's 14% slide over the past year, while the S&P 500 has climbed. The common belief about MGM is straightforward. Las Vegas is back. It's an icon. The city is hosting massive events, conventions are returning, and international travel is picking up. In Macau, the regulatory crackdown from Beijing seems to have eased, and gaming revenues are climbing back, with MGM China reporting record market share. So, the thinking goes, MGM is a solid, if cyclical, holding. You buy it when the economy is good, you sell it when recession fears creep in. It's a simple barometer for consumer confidence. Many investors see this perceived stability as a good anchor for an individual brokerage account, something to balance against more volatile holdings like Nvidia stock or Tesla stock. But this view is dangerously simplistic. It misses the leverage, both financial and operational, that defines this company. The reality is that MGM isn't just a bet on the consumer, it's a high-stakes bet on margin expansion in its digital arm, BetMGM, and its ability to service a mountain of debt if the U.S. consumer finally pulls back. The consensus view, which holds a moderate buy rating with a price target floating around $47, ignores the fact that the company is fighting a war on two fronts. It is desperately trying to maintain relevance and margins in its legacy brick-and-mortar operations against new competition, all while trying to claw market share in the cutthroat U.S. online sports betting market. Let's look at the recent stock movement. That drop today isn't happening in a vacuum. The stock has been trading in a very volatile range, and it took a significant hit just over a week ago following its Q3 2025 earnings report on October 29th. The market reacted very poorly. Why? Because while revenue was up slightly, driven by a strong performance in China, the company missed analyst estimates on profitability, reporting earnings of just 24 cents per share versus an expected 37 cents. Even worse, it posted a net loss of $285 million, which management blamed on a large non-cash goodwill impairment charge related to its decision to withdraw its application for a commercial gaming license in New York. This signals a pullback in expansion plans. Furthermore, revenue at its core Las Vegas Strip resorts actually fell 7%. Management admitted on the call that they lost control of the narrative over the summer, noting softness in occupancy and room rates, particularly at mid-tier properties like the Luxor and Excalibur. This shows you how sensitive it is to macro headlines. Any hint that the consumer is pulling back hits MGM directly. This isn't the high-flying story of Apple stock. This is a ground-level business that feels economic shifts immediately. Then there's the Macau segment, MGM China. This was the golden goose for years, then a massive liability, and now it's the biggest bright spot. In Q3, MGM China achieved a record 15.5% market share and record adjusted EBITDA. The market has been recovering, with mass-market gaming revenue in Macau showing resilience. But this is a fragile recovery. It's almost entirely dependent on the health of the Chinese consumer and the goodwill of the Beijing government. Any renewed regulatory pressure or a deeper slowdown in China's economy could halt this recovery instantly. Traders on platforms like Interactive Brokers, which offers sophisticated global market access through its Interactive Brokers trading platform, are watching the Hong Kong-listed shares of MGM China just as closely as the US-listed MGM ticker. The expectation is a smooth recovery. The reality is a fragile one, completely dependent on geopolitical stability. But let's be blunt. The entire bull case for MGM stock from here, the argument that takes it from a $32 stock to a $50 stock, rests on BetMGM. This 50-50 joint venture with Entain is the company's digital arm. For years, this was a cash furnace, burning hundreds of millions of dollars every quarter in a promotional war with DraftKings and FanDuel to acquire customers. The market hated it. You could see the stock sell off every time management talked about investing in digital. The expectation was that they would never catch up, but the reality is starting to shift. BetMGM reported strong revenue growth in Q3 and, crucially, management raised its full-year 2025 guidance. They also announced that the venture would begin making cash distributions to its parents, MGM and Entain, by the end of this year. This is a huge milestone, suggesting a turn toward sustainable profitability. However, the reality is also that its market share is stagnating. It's holding a solid third place, but it's not gaining on the top two. And now, new, well-funded competitors like ESPN Bet are entering the field. So the new tension is, can BetMGM grow profitably? Or did it just cut its marketing budget to show a profit while sacrificing market share it will never get back? This is the debate driving institutional ownership. This is why some investors prefer the pure play of DraftKings, while others see MGM as a safer way to get exposure to the sector, using their Fidelity Wealth Management advisor to build a position. The Sophie Invest platform, which offers both Sophie Active Investing and Sophie ETFs, has seen a lot of interest in gaming ETFs, but many are asking if buying the parent company, MGM, is the smarter self-investing move. This all ties back to the balance sheet. MGM is not a nimble tech company, it's a real estate behemoth. It has billions in long-term debt. This debt was manageable when rates were zero, but as it needs to be refinanced, the interest expense is going to creep up, eating into those earnings. The company has done a good job selling off assets, like the Bellagio and Aria real estate, to become asset-light, but it's still locked into massive long-term lease payments. This creates fixed costs that are brutal in a downturn. So when you see the stock wobble on inflation news, it's not just about the customer, it's about the company's own borrowing costs. This is the kind of detail that separates a casual Robinhood stock trading enthusiast from someone doing deep online investment research or trying to invest online successfully over the long term. This is where investment help becomes critical. Let's talk about the smart capital. Recent 13F filings show that over 1,100 institutions own the stock, holding about 82% of the shares. But the activity is mixed. We see some active hedge funds trimming positions, citing the consumer risk. At the same time, major holders like Davis Selected Advisors have been adding to their stakes, suggesting they see long-term value. This institutional rotation is what's keeping the stock in this channel. It's a tug of war. The value investors, perhaps using Schwab Intelligent Portfolios for a rules-based intelligent portfolio approach, see the low price-to-earnings ratio when you back out the one-time charges and the asset value of its properties. The growth investors are seeing slowing momentum in Vegas and are rotating out. What about the analysts? After the earnings miss, Barclays cut its price target to 42. The consensus, as we noted, is a moderate buy with a price target floating around 47.58. But the range of estimates is wide. The bull case is a technology and margin expansion story focused on BetMGM. The bear case is a classic cyclical macroeconomic story focused on a slowing U.S. consumer and high debt. The stock is trapped between these two powerful narratives. This is why investment sites and forums are so split on MGM. You need to understand that when you buy an investment like MGM, you are buying multiple businesses at once. So, for those who aren't familiar, let's quickly clarify what MGM Resorts International actually is. It's not just the MGM Grand, it's a portfolio of some of the most iconic properties on the Las Vegas Strip: the Bellagio, Aria, Mandalay Bay, the Cosmopolitan, Park MGM. It also operates a significant number of regional casinos across the United States, from Atlantic City, the Borgata, to Detroit and Mississippi. That's the first part of the business. The second part is MGM China, which operates major properties in the world's largest gaming market, Macau. And the third, as we've discussed, is BetMGM, its 50-50 joint venture for online sports betting and iGaming in the US and Canada. The company makes its income from casino winnings, hotel rooms, food and beverage, and entertainment. It's a classic hospitality model, but with the high-margin gaming component and the new digital lottery ticket, BetMGM, attached. Looking ahead, what are the real catalysts? The expectation is that more states will legalize